All right. Today is Thursday, March 31st, the last day of the month, the last day of the pumping, which did not go so hot today, right? This is a recap for the stock market activities today. Folks, I got a good one for you tonight, and let's not waste any more time, and here it is. In focus tonight. The Ultimatum by President Putin, paying rubles or no more gas. But before we talk about that, the most important news of the day was another tragic piece of news, another unfortunate, misguided piece of policy, once again, courtesy of the Biden administration. Today, they announced that they're going to abuse the SPR once again, the Strategic Petroleum Reserve, which meant, by the way, for times of emergency in this country. By now, the Biden administration, after the begging tour did not work out, begging Iran, begging Venezuela, begging Saudi Arabia, begging UAE, and many other countries, after all of that failure, the Biden administration resorts once again to the SPR. And now they're considering releasing 180 million barrels out of the SPR, which would be tragic, because this is the equivalent of 1 million barrels per day, depleting the emergency reserve of this country. And of course, oil prices went down 4% only. And we've seen before, every time the Biden administration announced releases from the SPR, we see a drop during that particular day. Oil goes down 3, 4, 5%, and then it rebounds higher again, which defies the purpose to begin with. What a colossal of stupidity. And of course, Biden is now promising the gasoline prices will go down anywhere from 10 to 35 cents per gallon at the pump. The problem is, you're depleting the strategic reserve of this country. We're going to go down to the lowest level since 1984, which will leave the SPR with only 400 million barrels. You know what that means? When the strategic reserve was already depleted to begin with, 400 barrels means 20 days worth of emergency use, because the United States consumes about 20 million barrels per day. So when the Biden administration says we're going to release 180 million barrels, that is the equivalent of 9 days worth of consumption. It's not going to do anything at all. To begin with, we have the monetary inflation with the Fed printing trillions and trillions and trillions of dollars out of thin air. That is the core and the root of this inflation. But the Biden administration would never address that. The Biden administration would never say, hey, Mr. Powell, this is your responsibility. You caused this inflation, and you better start tackling this inflation right now. Man up and start announcing interest rate hikes immediately. An emergency meeting to increase interest rates to tackle this inflation, which is crushing American households. No, they're not going to do any of that, because God forbid stocks would go down. See, the Biden administration is doing this delicate dance. They want their cake and they want to eat it too. They want to punish Russia and take 5 million barrels out of the market per day, and they expect nothing to happen. They want to please the consumer at the pump to prevent the political backlash, but they also want a stock market that is high, because if the stock market goes down, God forbid, they could lose the elections in November. And guess what? They're going to lose the elections either way. The stock market is going to go down, and oh, by the way, inflation is going to surge out of control. It is a lose-lose battle, and the Biden administration is so confused right now. They're all over the place. The polls are the worst in history, and now they want to go down swinging, even if it means depleting the national strategic reserve of this country. And by the way, the Biden administration also came out today threatening oil and gas producers. If you have any land that you're leasing and you're not pumping oil from that land, you will be punished. We're going to increase your taxes. We're going to come after oil and gas companies. What are they supposed to do? How are they supposed to increase production now when you've waged war from the beginning against the fossil fuel industry? No funding, no incentives at all. And oh, by the way, there is massive inflation to ramp up the production and substitute 5 million barrels a day from the Russian output that is sanctioned right now. Well, they need to hire workers. There are no workers. There is a shortage of workers. Massive wage inflation. And when it comes to steel pipeline supplies, look at the prices. They're surging to all-time highs. All of this input cost for oil producers, how are they going to deal with all of that? But no, there is no consideration at all from the Biden administration. And this misguided policy of sanctioning Russian oil, we talked about this from the get-go. It's going to fire back, it's going to cause inflation at home, and it's not going to stop the war. And by the way, the Russians will find out ways to sell their oil elsewhere. In the meantime, inflation continues to move higher in this country. Today, we got the PCE core inflation, the Fed's favorite, and even that one is reading 6.4% increase year over year. We have Americans right now Googling food stamps because inflation is eating away their budgets and prices continue to move higher pretty much every single day. On top of that, more misguided policies from the Biden administration. Now they want to ramp up the production of EVs. Well, the materials are nowhere to be found. If you want to build EVs, you need aluminum, you need nickel, you need lithium, you need cobalt, you need many other sources. None, by the way, are produced in this country at a mass scale. We don't have lithium. Maybe we do, but we're not drilling it out. We don't have a lot of nickel. We don't have a lot of cobalt. Yet the Biden administration is now invoking the Defense Production Act to source these EV battery materials. Are we going to go big China for lithium and nickel now? How about Russia? This is total insanity, by the way. And what the Biden administration doesn't realize, by invoking the Defense Production Act, you're now putting the purchasing power of the U.S. government to compete in these resources in the open market. And this will push prices of lithium, nickel, cobalt, graphite, all of these materials will surge higher in price, and this will fire back. And it's going to cost more to produce these EVs, even if you can source all of these materials right now. By the time these cars hit the market, they're going to cost what? $70,000 at average? Who's going to buy them? Who can afford to buy them? And how is that going to solve the problem to begin with? You see, the government has this EV fantasy that if we produce more EVs, if we shift rapidly the so-called renewable energy and green energies, we will solve our dependency on foreign oil. But this is just a fantasy, because by shifting to the so-called green energies, we're going to compete more on these same limited resources, and we will push their prices significantly higher. And the majority of these resources, by the way, are not found here in the United States. We will make Canada richer. We will make Australia richer. We will make China richer. We will make Russia richer when the prices of these commodities surge out of whack, because we have the power of the government right now competing and bidding up these prices higher. And by the way, when we talk about the infrastructure and the readiness of the American infrastructure to handle EVs, we're not even close to being ready. You look at households, the percentage of EV owners who say they do not have charging access at home. Among all EV owners, 78% say they don't have access at home. And by the way, the price of electricity is moving significantly higher now that we have European countries competing for our natural gas. But the problem becomes even more evident among lower incomes. For those earning less than $50,000, 83% say they do not have charging access at home. And all of this stupidity, by the way, once again pushing the prices of lithium, nickel, cobalt, all of these resources significantly higher. And luckily for us, we can use that to our advantage, the stupidity from the Biden administration. For example, instead of chasing meme stocks like a bunch of zombies, why not bet on these resources with constant and consistent positive performance? For example, let's go back to a call that I made in this channel a few weeks ago when I talked about the stock LAC Lithium America. Take a listen. And lastly, what about the ticker LAC Lithium America? We've been talking about lithium prices moving higher. This is a name that appears to be bottoming. This is a chart that reminds me of the chart of gold right before the pop. You have a sloping line of resistance, and then you have a formation of higher lows. As if the chart is saying it is bottoming, it is ready to pop above the sloping line of resistance. And the fundamentals, by the way, support all of that, because lithium prices are surging out of whack in an unbelievable fashion. So why couldn't this stock follow through and also pop higher? I believe it will. Since then, the stock moved higher by over 60%. So again, when you have a stock like this, when you have the prices of these materials surging out of whack, what do you need meme stocks for? What do you need stupidity for? We're talking about over 60% gains in a couple of weeks. What more do you want? And rest assured, we will have more stupidity from the Biden administration that we can exploit and make money from. But the problem is, this misguided policy is punishing people at home with higher inflation and stumbling all over the place with the policies, pushing EV prices higher, pushing lithium prices higher, pushing gas prices higher, pushing oil prices higher, and now depleting the strategic reserve. But are we really punishing Russia with these sanctions? Because the ruble continues to move higher. The ruble now firmed past 84 to the dollar. Why? Because Vladimir Putin is now threatening European countries, what he calls unfriendly countries, to either pay Russia for its natural gas using rubles, or he's going to cut the supply entirely. And by the way, Russia exported 44% of pipeline gas in 2020, the largest of all countries. You want to sanction that? You want to take that out of the global supply? What do you think will happen? More and more inflation. And the biggest buyers of Russian pipeline gas happen to be European countries, but most importantly, Germany. And even Russian liquid natural gas, by the way, Europe happens to be the largest consumer of Russian liquid natural gas. And the question is, did we really think about the ramifications before imposing these sanctions? Something tells me we did not, because now we have G7 countries, Germany, Italy, the biggest consumers and importers of Russian natural gas, saying we're not going to pay using rubles. But Vladimir Putin came out today and made it clear, you're not going to use rubles to pay me, that I'm going to cut your supply. And now we have this standoff. Everybody's thinking that we have a peace agreement between Russia and Ukraine. Let's pump stocks higher. Yet what everybody's not thinking about right now is the economic war going on. We fired against Russia with the sanctions. We have yet to receive the counterpunch. And this could be the counterpunch. Russia demands payment in rubles or no more gas. And European countries, by the way, understand that if they pay using rubles, that defies the entire purpose behind sanctions. And it will push the ruble higher. It will recover the Russian stock market. And the Russians already finding alternatives to the sanctions. They're selling oil and gas to China, India. Chinese companies are filling the void from Western countries who left Russia. Who's going to end up the biggest loser from this stupidity? I have a hunch it's going to be Western countries. It's going to be us. Putin said buyers of Russian gas must open ruble accounts in Russian banks. It is from these accounts that payments will be made for gas delivered starting tomorrow or April 1st. If such payments are not made, we will consider this a default on the part of buyers, with all the ensuing consequences. Nobody sells us anything for free, and we are not going to do charity either. That is, existing contracts will be stopped, Putin said in a televised remark. Putin also said the switch to rubles would strengthen Russia's sovereignty. He said the West was using the financial system as a weapon, and it made no sense for Russia to trade in dollars and euros when assets in those currencies were being frozen. What is actually happening, Putin says? What has already happened? We have supplied European consumers with our resources, in this case gas. They received it, paid us in euros, which they then froze themselves. In this regard, there is every reason to believe that we delivered part of the gas provided to Europe practically free of charge, he said. That, of course, cannot continue, Putin said, although he said Russia still valued its business reputation and would continue to meet obligations in its gas and other contracts. And now Germany and Austria planning gas rationing over payment standoff with Russia. So here it is once again, the conflict could flare up economically speaking and spread wider than the borders of Russia and Ukraine. Did market participants factor in any of that when they were pumping the stock market higher the last couple of weeks? And now comes the moment of, oh yeah, that thing. We got to factor that thing, when they cut the natural gas supply, because that will cripple down economies in Europe and otherwise, and it will cause a massive sell-off in the stock market, specifically in European markets. It's going to be good for U.S. natural gas suppliers, and we talked about that in details in a previous video, and I gave you a list of names of what will happen if the Russians stop natural gas supplies to Europe. They're going to have to buy liquid natural gas from here, the United States. It will benefit certain companies, but this will also be humiliating to the West. All of this tough talk and the sanctioning, are they going to bow down and pay Putin using rubles? After all, we'll see. But the standoff will cause stock market volatility. No doubt about it. And with that, folks, we're going to move on and cover the market information for you. We start with the closing of the indices today, and here we go. The Dow Industrial Average down by 550.46 points, or a decline of 1.56%. The Nasdaq down 221.76 points, or a decline of 1.54%. The S&P 500 also down by 72.4 points, or a decline of 57%. The majority of the declines came pretty much during the last 30 minutes of the day, a massive flush down. It is the end of the month, the end of the quarter, so we will see if that was related to the end of the quarter, or is there more to the sell-off that we got today by the end. But here are the sectors' performances today. Not good. We're not giving any medals today. Shame on all of them. Every single sector of the market closed in the red, and the laggards were led by consumer cyclicals, communication services, and financials. And here are the advance to decline ratios. NYSE 27% advancing versus 71% declining. The Nasdaq 32% advancing versus 64% declining. And now we're starting to see once again more 52-week lows. So we're starting to see some damage starting to appear in the Nasdaq once again. Moving on to commodities, the news of the release from SPR of course damaged crude oil prices today. The WTI was down a little more than 6%. Likewise, Brent was down a little over 6.75%. Gasoline was down almost 4%. Heating oil was down a little over 2.5%, while natural gas closed positive. I am willing to bet to say that crude oil will rebound higher again, because whatever the Biden administration do, they're not going to be able to substitute 5 million barrels a day. It's just not going to happen. And depleting the SPR supply, that is going to cause higher prices in the long run, not lower. When it comes to softs, lumber was down again, almost 4%. Likewise, cotton was down almost 3%, while cocoa and sugar were pretty much in the flat line. On the other hand, we have gains of almost 3% for OJ, and even coffee scored gains of almost 1.75%. I am in coffee right now, and we will talk about the chart of coffee in details in this weekend's video. But let's go to metals. Flattish action for gold, silver, copper, palladium. No major moves whatsoever. The major move came from platinum. Platinum was down almost 1.5% today. Meats, red across the board. The losses were led by lean hogs, down over 2.5% today, along with feeder cattle, down almost 1.5%, while we have modest declines for live cattle futures. Grains, we talked about the rotation from soybeans to corn. Well, guess what? Corn was positive today, gaining a little over 1.25% today, while soybeans was down across the board, be it soybeans, soybean meal, soybean oil, all down big. And wheat was also down almost 2%, while we have modest losses for both oats and canola. On the other hand, rough rice closing modestly in the green today. When we talk about the rotation from corn to soybeans, it is becoming evident now. Farmers are planting more soybeans than corn. We will have a shortage of corn. This will impact not just corn, but also livestock and many other products. Matter of fact, today the USDA came out and said the U.S. corn and soybean stocks are rising, but corn plantings are actually down, and they cut the forecast for corn. Corn futures climbed Thursday after reports that the U.S. Department of Agriculture on Thursday revealed higher U.S. corn and soybean stocks, along with a lower forecast for this year's planted corn acreage. U.S. corn stocks were at 7.85 billion bushels on March 1st of this year, up 2% compared to the same time a year ago, and soybean stocks were up 24% at 1.93 billion bushels. All wheat stocks, however, were down 22% from March 1st, 2021, at 1.02 billion bushels. The USDA data showed. So again, we're going to have a shortage of corn in the future, and we already have a shortage of wheat, and this shortage will intensify in the months, perhaps years to come. Moving on to options, the big casino. At number 1, Apple, with around 1.1 million contracts traded today for the name. About 55.5% of those were calls. And at number 2, a loser for the day, big time, AMD, which was down better than 8% today, but we have over 1 million contracts traded for the name today. About 68% of those were calls. At number 3, AMC, with around 700,000 contracts. About 69% of those were calls. AMC also stalled today, down a little over 4%, but we have the stock split news after the bell for GameStop, and this could impact AMC positively. Moving on to the unusual activities that took place in the options market today, we start with the ticker THCA, Tuscan Holding, and the name was up big today, over 8% gains, and somebody's betting for more gains to come by buying the 12.5 calls for the expiration date, April 14th, with the expectations the name could pop higher by more than 11% by then. They paid around 60 cents a piece to enter this trade, all in all spending around $1 million. What about the ticker TWTR Twitter? They're buying calls on Twitter. Interesting. In this case, the 43 calls for the expiration date, April 29th, with the expectations that the name could gain over 11% by then. They paid around $1.25 cents apiece to enter this trade. All in all, spending around $2 million. What about the trade for the ticker AMD? Down big today, but somebody's betting on a rebound by buying the 115 calls with expiration date April 8th, with expectations that AMD could rebound by more than 5% by then. They paid around $1.50 apiece to enter this trade. All in all, spending around $2 million. What about the ticker FLR for Floor? It is a top performer year to date, not recently though, but somebody's betting for a resumption of the gains by buying the 32.5 calls for the expiration date May 20th, with expectations that the name could pop higher by more than 13% by then. They paid around $1 apiece to enter this trade, all in all spending around $1 million. What about the ticker MT, ArcelorMittal? They're buying calls here, the 36 calls for the expiration date May 20th, with expectations that the name could pop higher by more than 12.5% by then. They paid around 75 cents apiece to enter this trade, all in all spending around $450,000. And lastly, at the bottom of the table, look at this. AMZN, Amazon. We have some news that we're going to cover in the heat map analysis in a minute, but they're buying puts this time around, the 3,000 puts with expiration date April 8th, meaning next week, with the expectations that Amazon could drop down by more than 8% by then. They paid around $5 apiece to enter this trade, all in all spending around $3 million. Moving on to the heat map analysis. A sea of red, losses across the board, with few winners here and there. Most importantly, the agricultural names, the fertilizer names, even in consumer defensives, ADM was up today, Kroger was up, certain travel names were up in cruises and airlines, Intuit was up in technology, the ticker INTU for obvious reasons, of course. Some solar names were also up, but again, nothing major here. It was negative action across the board. We were anticipating a pullback, we're getting the pullback. And it is more inclusive than we thought. The question is it going to morph into more selling, perhaps more indiscriminate selling again, or is it going to be just a pullback and then we're going to buy the dips again? Most importantly, where will the dips be bought? For me, I stick with the winners. I'm going to stick with energy, gas, metals, fertilizers, grocery stores, the consumer defensives, big pharma, the defense names, railroads, until things change. And for now, nothing has changed. When we talk about the notable movers, how about Micron, MU? The name reported earnings not so long ago, and the gross margins for the company, the profits, are improving dramatically. But nobody loves Micron, regardless of the attractive valuations, regardless of the fundamentals of the company. So Micron was an underperformer today. Obviously, the news that we got after the bell, GameStop is splitting its stock. I mean, couldn't you wait for the stock to split organically when it crashes? You want to split a garbage stock? I don't have a lot of confidence in this move, but the zombies get excited every time we have a stock split, be it in GameStop or Tesla or otherwise. So the assumption for now, we will see GameStop moving higher tomorrow, specifically if it triggers more short covering along with the excitement of the stock split. Amazon was also a notable mover today. It was actually down 2% or so, but we have news, and it is disturbing, by the way. We have Amazon workers over at Staten Island attempting to unionize, but Amazon is now using intimidation tactics to bully the workers and discourage them from unionizing. Amazon is hiring a big shot Democratic pollster to intimidate these workers. And listen to this, by the way. This is disturbing. The company, GSG, this is the company that Amazon hired. They created flyers and viewing materials, propaganda materials to dissuade these workers not to unionize. On top of that, they've been also monitoring social media accounts for these workers. So now you don't have the freedom to speak in social media because they're targeting these workers. These are intimidation tactics. Who's going to vote for the union, by the way, when you have professional companies stalking your social media accounts, probably spying on your phone? This is corporate slavery. They want to keep you intimidated. You better work for us, or the moment you start complaining and demanding better working conditions, a better pay, we're going to hire these professional bullies to intimidate you. And oh, by the way, we will give you the boot sooner or later. You think the workers are going to vote in favor of unionization when they're being intimidated? Absolutely disgusting stuff by Amazon. And if that wasn't enough, we have more disturbing news this time around from Activision Blizzard. You remember the deal when all of a sudden, out of the blue, Microsoft announced buying Activision Blizzard for an insane buyout price that didn't make sense at all. But maybe it does now when you realize that there was insider trading going on before this deal took place. We got the news from the Wall Street Journal today that Activision CEO, who's by the way embattled with the disgusting culture over Activision, well, turns out that the CEO met beforehand. He met with Alexander von Fressenberg, who's by the way a relative of Barry Diller's wife. He, along with Barry Diller and David Giffen, bought options to purchase Activision shares at around $40 each on January 14th. And once the deal was announced, they were able to flip these call options for a $59 million worth of profit. This is corruption on a mass scale, and it involves big names. It involves untouchable names. You know, the kind of names who actually own the Fed and own the SEC, own the Justice Department. So again, are we really expecting that these guys will receive any punishment whatsoever? Of course not. They're going to get away with it, even though it's clear as broad daylight that this is corruption, this is insider trading. But if it happened with Activision Blizzard, isn't it happening across the board with these insiders buying block call options randomly on Tesla or Nvidia and pumping these stocks higher? Making profits by manipulating these stocks higher using call options. Where is the SEC, you might ask? The SEC remains in a coma. This is a crime scene. The stock market is becoming unbearable. Manipulation all over the place. Pumps and dumps all over the place. We have powerful players abusing the rules, cheating left and right to make profits. What has this market come to when we don't have an SEC that is active at all? When the SEC is in the pockets of these billionaires. When the Fed is in the pockets of these billionaires. Crime is rampant. They get away with anything, but God forbid you and I start a small scheme of pumping a stock. We will go to jail right away. The SEC will be here right away, but the rules are not applicable to these billionaires and insiders. What a disgrace. But for all of you who doubt that this stock market is manipulated, or we're seeing insider trading all over the place, from the billionaires, from the politicians, from everybody, if you doubted that is true, now you know. Moving on to the heat map for the ETFs. A sea of red across the board, the inverse indices lighting up green along with the VIX. Certain commodities like URA, uranium was up. UNG for natural gas was up. But besides that, it was an ugly day. Even international markets were down across the board. When it came to the growth versus value performances, they're both down equal amount. There is nothing to see here. All what we have to do is wait whether this is a pullback or something more. And for that, we have to move on to charts. We start with SPY. The S&P 500 30 minutes chart. On face value, all the way till the last 30 minutes of the day, there was no damage at all to this chart because it lost 461 and 459 as support. That's all there is. But then came some alarming signs by the end of the day. Number one, the chart lost the support of 454. But most importantly, it went down to close the gap and it failed to bounce. It closed at the lows of the day below the gap. And if we had more time, we would have lost 451 as support. Is this a reversal? Not really, not for now, but it is an alarming sign because we were expecting a pullback. We're getting the pullback, but things accelerated by the end of the day in an alarming manner. Was that just the end of the quarter kind of selling, or is there more to that action? Are we going to see a continuation of that action, let's say starting tomorrow? And if that is the case, let's say the chart goes down and loses 466.5. Still, no significant damage. But you go down to 443 and you lose that, and then we get a problem, a big one. For now, the RSI is becoming oversold. So can we get a bounce from, let's say, 451? I think we could, but who's to say that the chart is not going to gap overnight and we go down to 446.5 right away? If that happens, we will get a bounce in the morning guaranteed because the RSI will be extremely oversold and this will elicit a reaction by the algos. The question is whether the chart rebounds from 451 or 446.5 or any other number. The most important question is, will we see buying of the dip again, or will it be a rebound and then a resumption of the selling? Two different scenarios. If we have more dip buyers, then you have your answer. Dip buying is still alive and the chart will recover and hold ground. But if we have a resumption of the selling right away, then we get a problem because we're eyeing lower prices and the dip buyers are not showing up. And soon enough, all of these people who bought this rebound higher, well, if the chart starts to go down to 446.5, 443, you're going to have people sitting on losses, even though they bought the rebound that everybody thought is going to take us to all-time highs. And then they start to capitulate. They start to book whatever profits or whatever losses they have now. And that accelerated the losses all the way down. So for now, no harm done, no significant harm done, but it all depends on what will happen tomorrow. Are we going to get a rebound? And will the rebound hold, because if it doesn't, then the problem is going to start to appear on the radar. Moving on to the daily chart for the continuous contract for the SPY. Again, any damage here? Not really, because we lost 4,549.5. But the bulls built up a lot of cushion in this rebound higher. We have 4,472 as support. We have 4,384.5 as support. Let's say we have a pullback from this point on that takes us all the way down to 4,384.5. Yes, we have a pullback. Yes, we have certain buyers of the rebound losing their money. But all in all, if the chart rebounds from 4,384.5, is there any damage here? Not at all, because the chart is still making higher lows. So what do you mean, Maverick? We're gonna wait till the chart breaches below 4,102 and then we become bearish? No. You can short right now if you want to, but you have to short with the anticipation that this is still a pullback of a magnificent rebound. The expectations were for a pullback, and for now, it is a pullback. You can play the pullback if you want to, but it is not a reversal yet that could produce that flush down that you and I as options traders perhaps looking for. Do we have signs that that could happen? Yes, we do, because the volume is bottoming and moving higher again. That is a sign that the recent move has already topped in the SPY, and now we're seeing the counter of that move. The question is, how low will it get us? Likewise, the momentum indicators are topping. They're starting to curl down. Look at the MACD indicator, for example. These green columns are getting shorter and shorter and shorter. The problem is, for a flush down scenario for the chart, for it to lose 4,472, or perhaps 4,384.5 rapidly, we need a catalyst. Will the catalyst be the standoff in natural gas between Russia and Germany and other countries? Will the Russians cut gas supplies altogether? That could induce a lot of volatility and give us that flush down that could be considered as a reversal. But for now, we're just pulling back. That's all there is. When we look at the SPX, the cash index, the chart is still above the 200 days moving average. If it crosses and closes the week below the 200 days moving average, then you have a shorting signal, perhaps a solid one in the pullback that we got today. But we have an encouraging sign for the bears, and that is the chart lost 4,590. Remember, the chart cheated that number. It gapped above it. Now it lost it again, and it closed below the gap. That is an ominous sign. And by the way, this number will be stiff resistance. The chart will not be able to make it above that number again easily. You cheated once, there isn't going to be a second time. So the weekly closing becomes really important now. A closing below the 200 days moving average will seal the deal for the bears by initiating a shorting signal. Here it is, the Q's 30 minutes chart. Any damage, significant damage, the bullish run? Not really. The chart lost a few support lines, but it remains trading above 360. And the most important line for now, 352. Let's talk about the ideal scenario for the bears, for example. The ideal scenario would be, look at the RSI. It is becoming a little oversold. So let's say the chart opens down, gapping down at around 360, and then it rebounds higher. You will be watching. If the chart reverses and loses 360 again, that would be a shorting signal. All the way to what? The 352. See, if you get too excited and you buy way out of the money puts with a shorter expiration date, you could get slaughtered right away. So the key here for the bears is keep your trades tight. If we have a breach again below 360 after a rebound, then we're going down to 352. And that should be the target until that is lost. And then we have 343. You're better off playing these pullbacks accordingly rather than buying way out of the money, let's say 320 for example, with a shorter expiration date. And yes, the chart could pull back all the way down to 352. And now you're jerking off, being too excited about the gains. What do you know? The chart rebounds higher from 352 and initiates another rally higher. And now you lose all your gains. So remember, for now, you gotta be always be closing and use these support lines as targets. Watch the behavior of the chart. It will tell you and guide you whether you should short or you should buy the dip again. How would you know to buy the dip again? That this is all there is for the pullback? If we have a rebound on Friday that sustains the gains all the way till the end of the day, closing at the highs of the day, recapturing some of the ground lost. We're talking about 365, for example. Better yet, 369. Then we know this chart has higher highs to go. And here's a daily chart for the continuous contract for the Qs. It stopped at around 15,260. The momentum indicators are stalling. The volume is starting to creep up again. All of these are signs that we do have a top for now. And indeed, the chart pulled back and it lost 15,000 as support. But for now, no significant damage done to the rebound. We will talk about significant damage when, let's say, 14,445 is lost. But until then, for all you know, the chart could move higher again. And all what we got is just a pullback. It all depends on the blood waiting on the sidelines. If they see a rebound higher again, they will be encouraged because the FOMO kicks in and they're going to stampede to buy. But if we have more losses here and we start to go below 14,445, think of what's happening to the guys and gals who already bought the rebound at numbers above 14,445. They start to lose their money. The blood waiting in the sidelines starts to get discouraged. The bears are back, the sell-off is back, here comes the fear again, and we're not going to buy. And that intensifies the flush down. So the psychology is extremely important here, folks. You got to factor that in. But yes, for now, you got your pullback. You got your confirmation for the pullback. The volume is moving higher. The momentum indicators are stalling. All of these are signs that the rebound ran out of gas and we have a confirmation for a pullback. The problem is, where will that pullback get us? That is an important question to factor in, an important question for the future. This rebound. Was it a dead cat bounce? Was it a bear market rally? All of these questions will be answered depending on where the pullback will get us. But for now, you can play these pullbacks by adjusting your expectations accordingly, by using the support lines reasonably, not buying way out of the money puts with shorter expiration dates and then you start crying again. And for those who made money buying calls from this run up higher, well, it is no brainer that this is the time that you start to take your profits. What about the IWM? The Russell 2000 30 minutes chart. More damage in this chart because it lost 211 as support, it lost 208 as support, and perhaps if we had more time today, it could have lost the most important line, 204.5. So the question for now is, we know the RSI is getting a little oversold. Let's say the chart gaps down at around 204.5. Or maybe below that. Will it recapture the line and close the day above the line, 204.5, or will it lose that support? And you're going to trade accordingly, knowing these facts. If the chart appears to hold 204.5, that is bullish, not bearish. If the chart crosses above 204.5 again, but then loses that as support, then you know that is a solid bearish signal. Let's brainstorm another scenario, perhaps a crazier one. Let's say the futures gap up higher in the morning for whatever reason. The question is, will they sell the rip and will the chart lose 204.5, let's say midday, earlier in the day? You gotta watch the chart's behavior. If it gets rejected from 204.5, that would be a solid signal to start shorting. Moving on to the Dixie, the dollar index, a rebound for the Dixie today. Oh, we've been talking about this, by the way. You're not going to call it dead until 97 is lost as support. And by the way, we now have more warnings from the IMF saying that the Russian sanctions will threaten to chip away at the dollar's dominance. We talked about that in details. All of these sanctions are firing back. It's going to favor the yuan and other currencies, and it's going to hurt the dollar in the long run. What about gold? Gold is still holding in a bear flag pattern, and that bear flag pattern could play out any time now. But we have a battle. We have the resiliency factor of gold that it continues to hold on over and over and over and over, waiting for buyers. But if the buyers don't show up for whatever reason, if they are distracted by the recent move in the stock market, or perhaps meme stocks and the likes, then buyers are not going to show up for gold, and instead the sellers will show up. And therefore, continue to say, gold better start moving higher sooner than later. Yes, the negative momentum is kind of bottoming, but we got to see that pop, that oomph, because absent of that, you will see a lot of holders being discouraged and saying, you know what, I've been waiting for gold to pop higher, it didn't happen, gotta move my money elsewhere. The question is, do you move it to stocks? Do you move it to oil, for example, Brent? Because take a look at what happened here. We talked about a reverse head and shoulder formation, but that reverse head and shoulder formation was within a larger bear flag pattern. And the bear flag played out today, specifically after the fundamental news of the release from the SPR. But all in all, folks, the chart is still holding 105.84 and perhaps forming what it appears to be a double bottom. And it would be a massive pie in the face for the Biden administration if this chart rockets higher from the double bottom right now, regardless of the millions of barrels they're about to release from the SPR. What about the 10-year yield? We're watching 2.34. Will that hold, or will we see a flush down in the 10-year yield? Now, notice the correlation, by the way, between the 10-year yield and the NASDAQ. They went higher together, so the assumption is if the 10-year yield tops and starts to go down, so will the NASDAQ. And perhaps this was the leading indicator earlier in the week that we were about to see a pullback in the NASDAQ, because because there was that one day when the 10-year yield was down, yet the Qs ended up higher. And we pointed out this divergence in the show. And I asked the question, by the way. I said, is this going to be a leading indicator that the Nasdaq is about to pull back? And now we have the answer. So you got to watch this chart carefully. An important number is 2.34. If that is broken, we could see a flush down in this chart that could come hand in hand with a flush down in the Qs. And therefore, I continue to hold on my TLT calls. This is a weekly chart. So far, so good. We have a rebound from 128, and that could lead us all the way to 134.5. We know the momentum indicators got really oversold, and they're rebounding higher now. So there could be more gains to come. By the way, it was a horrific quarter for bonds. Will we see more money being allocated for bonds in the second quarter? Tomorrow's action will be really important as a leading indicator for bonds. Moving on to the VIX 4-hour chart. Look at the MACD indicator. Last time around, producing green impressions of the histogram did not produce a pop. And that was the first time, by the way, since June of last year. And I said, I'm not buying this action. I'm smelling a trap here. I think the VIX will pop higher. And now it appears that the VIX is bottoming at around 20. And it is producing positive momentum, at least looking at the MACD and the RSI indicators. The most important question right now is, will the VIX close the day above 20 for the week, meaning Friday? That will be a massive win for the bears. Because yes, they hit the VIX, the bulls hit the VIX all the way down to 20, but they failed to close the week below 20. And all what they gave us is an opportunity to buy puts and hedges at a cheaper price. Similarly, this is the VXN 4-hour chart. We talked about the bottoming of the negative momentum. Even though there is a negative pattern, the bear flag played out, the chart lost 27.5 as support. It is now battling to climb above 27.5. And remember, 27.5 is the equivalent of 20 in the VIX. So weekly closing above this number is a major victory for the bears. You look at this MACD indicator. It has been negative for a long time. When it popped, will all of that energy be released to the upside in an aggressive manner? If that is the case, then the Qs will flush down. We've been talking about a pullback. Will it morph into a flush down? Well, this chart will hold the key to that answer. What about Apple, the daily chart? Look at the pullback. The momentum indicators are curling down. They already topped. The volume is moving higher again on the selling side. All of these are good signs for the bears waiting to short this chart. But so far, no major damage done to this chart. It didn't even lose 172.4. We're not going to talk about significant damage to this chart until it loses not just 172.4, but also the upper border of the channel in yellow, which is now support. It will be around 170, 169. If that is lost, then we get a problem. Then we could see the acceleration and the flush down. What about Tesla? This is an hourly chart. Tesla's holding. It lost 1,090.5, but so far this is not a big deal because you can read the psychology of the chart from the behavior. The buyers of this chart remain resilient. They bought the dip in Tesla, believing the stock split, believing Elon's promises, believing whatever garbage they believed in. And they're holding for now. They're not going to sell. They're not intimidated to dump Tesla right now. They will be if two things happen. Number one, the market maker, starts to dump their share from the gamma squeeze. Number one. Number two, some of the buyers, some of the insiders who bought, let's say at around 825, 850, start to book profits, and the chart flushes down and it loses 995 as support. Then a lot of the holders, despite the resiliency, they're going to start to think, I got to book some profits now before these profits turn into losses. And we see the flush down perhaps all the way to the trend line in yellow, which will be at around 950 at that time. The question is, do you bet against Tesla now? Do you buy put options? If you do, tamper your expectations all the way down to 995 to closing the gap. Don't go crazy buying these 700 puts with the weekly expiration and then you end up losing your money again. For now, all what we're looking for is a pullback. We're not looking for the end of the bounce or a massive flush down, at least not right now. What about Bitcoin, daily chart for tulips? Again, like every other chart, pulling back, running out of gas, but for now, it is a pullback. It is simply running out of gas. We will see if the buyers on the sidelines are going to show up or not. If they don't, the sellers will, and they will take us all the way down to 42,000. If 42,000 is lost, then we have a shorting signal instead of a buying one. And lastly, what about AMC, a 2-hour chart? The bad news is the chart lost 26 as support, and it attempted to recapture 26 once again, as I'm highlighting in the chart, and it got rejected. It did not make it above 26. The good news is we have a stock split in GameStop. Will that excite more buying of call options tomorrow? Maybe a revival of the gamma squeeze, whatever left of the gamma squeeze, maybe some organic buying of AMC shares, expecting perhaps that AMC might announce a stock split at what, $25? But regardless, it all depends on the psychology now. More buying could indeed push this chart higher again above 26. It is not impossible. If we see a recapture of 26 as support again, then I'm going to close the rest of my puts because perhaps we will see more gains in this name. I already closed 50% at an excellent profit, a steak and lobster kind of trade, and I'm hoping the rest takes me all the way down to 21. That will be the end of the trade. But we get above 26, for me, that would be a signal to book whatever profits I have left in the trade. And lastly, let's move on to the conclusion of this video. What do we have on the economic calendar tomorrow? A big day, an important day, because we have, once again, the non-farm payrolls. The kitchen will be busy in the morning. Busy doing what? Giving us a reading in the sweet spot. Not too hot, not too cold. Not too hot to incentivize Jerome Powell to become even more aggressive, but not too cold to give us the illusion that the economy is still intact, the pace of growth, unemployment still intact, but you bet the stock market will react to the number one way or the other. And then we have the manufacturing PMI and the ISM manufacturing index. Both of these will be important. We also have construction spending and motor vehicle sales. And on top of that, we have another Fed zombie from Chicago, Charles Evans speaking. He remains the last dove standing, the only one against the 50 basis points hike. Anyhow, folks, this is all I got for you for now. Thank you for listening. Thank you for watching. I will talk to you again tomorrow. Yes, tomorrow. We have videos coming out tomorrow.